Good afternoon. This is Tony Cherniawski, President of the Practical Investor, LLC. Today is October the 26th, 2008. The name of this program is Flags at Half-Mast Over the Market. What I'd like to do is bring some technical analysis into the picture here to tell you what's going on behind the scenes in the market and to explain the behavior of the marketplace in the last couple of weeks. 2 weeks ago we had a decline to a new low in the Dow and the Standard & Poor's that evoked the sentiment that possibly that the decline was over. We were seeing CNBC telling folks that the bottom is in, it's time to start buying. As a matter of fact, I have never seen so much bullish sentiment in my life as I did last Monday and Tuesday. I believe these guys were really sweating bullets at that point, but nonetheless, the behavior of the market since then has reinforced that behavior a bit. So what we want to do is talk about the psychology of the markets and a little bit about the formation that we may be experiencing right now. What we have is called a bearish pennant. The pennant consists of three parts. The first is the flagpole. This goes from the upper left-hand corner down to the midpoint. Then we have a consolidation period in the form of a triangle or pennant formation. And then finally we have a pivot at the end of the pennant with a potential price target equal to the flagpole. If we look at the Dow Jones Industrial Averages, we see the flagpole is fairly evident. And in fact the pennant is there, except that it's missing the one last little ripple in the flag, which usually goes to the top of the pennant trend line. Instead, what we saw was a breakdown in midweek where the third touch, which is known as the pivot, actually reached the underside of the pennant rather than the top side of the pennant. We see the same thing in the Standard & Poor's. So let's talk about this a little bit and determine where this market could go. Using the pennant formation, we have a target decline in the Standard & Poor's of 426 points. This is the measure of the top of the market on September the 19th down to the bottom on October the 9th. The pivot point, as best I can determine, is about 911. This leaves a pennant target of 485 on the Standard & Poor's. If we go to the Dow Jones Industrial Average, the flagpole is 3,709 points in length. The pivot point is 8,691, leaving us a target of 4,982. Yes, folks, we're talking about a Dow below 5,000, possibly occurring in the next week or two. This is important for you to know, and thus the reason for my video. Why could the market, or how could the market, reach such a target in such a short period of time? One of the reasons why is that the bad news isn't over yet in the marketplace, unfortunately. We've seen declining earnings in the Standard & Poor's. Believe it or not, common wisdom is that you should sell the Standard & Poor's when it reaches a price-to-earnings ratio of 20. Believe it or not, the earnings this year have declined by 40% already, meaning that at the beginning of the year we had a Standard & Poor's price-to-earnings ratio of 20. Believe it or not, we still have a price-to-earnings ratio of 20. So in other words, the market's gone down 40%, so has the earnings in the marketplace this year. In addition to that, we have a severe crisis in the banks that may not be over as well. So what could exacerbate this decline and make it so radical and in such a short period of time? First of all, we have a tradable bottom sometime in the next 2 weeks or so. This comes about from the cycles. Cycles work is not precise, but it gives us a good range to look for a market bottom. So I'm expecting to see a tradable market bottom sometime within the next week or two. It could extend into election week, as a matter of fact. Now, not only do we have bad news, but we also have the market curbs, the so-called circuit breakers that are meant to stop the market from going down. In fact, in a decline such as this, I believe that the circuit breakers will exacerbate the problem. Here's why. The level 1 circuit breaker is a Dow of 1,100 points. This is a decline at this point from roughly around 9,000. We're talking about a 12 or 13% decline. That's pretty significant. And I don't think people will stop and think twice about it. You know, should I be buying the market now? No, I think they'll be selling the market at that point. The second circuit breaker is at a 2,200-point drop in the Dow. By the way, the 1,100-point drop only halts the market trading for about an hour, and the 2,200-point drop only halts the trading for about 2 hours. I believe that in the coming week we could see anywhere from 1 to 3 1,100-point circuit breaker stops in the marketplace. This is a good market to stay out of, especially if you're not familiar with what's going on. For those that are trading and know that and have profited so far from the market decline, this may be a potential to reap some pretty immense profits in the marketplace. By the way, one of the points that I'd like to make is that short sellers are often the only motivated buyers at the bottom of a market. So what's interesting about this is when we see the market rally up at the end of this decline, it'll be the short sellers that you can thank for the bottom occurring and the market giving itself a chance to go back and recoup some of the losses. In the meantime, I want to thank you for your viewership and your loyalty. I've gotten some very good comments on these videos. I can be reached at TonyC@thepracticalinvestor.com. I can by phone. The number is area 517-699-1554. This video is not meant to give trading advice of any kind. There is no solicitation to buy or sell any product here. This is simply meant to inform and bring light on what's going on to the market for the average person. Thanks very much for your time, and I hope you have a great week, a safe week, and do the right thing.